Ever pondered how companies get their worth? Ever found yourself asking, how much is this company really worth? Well, you're not alone. These questions lie at the heart of a fundamental concept in finance and investing: valuation. Valuation is the process of determining the current worth of an asset or a company. It's a pivotal part of decision-making in the business world, from mergers and acquisitions to investment strategies. But here's the intriguing part. A company's value isn't just about tangible assets like buildings or machinery. It also hinges on intangibles, like brand reputation, patents, or even the company's potential for growth. It's a complex equation, intertwining various factors and variables, each with its own weight and significance. And that's exactly why we're here, to decipher this equation, to understand the intricate dynamics of valuation. So, let's dive into the fascinating world of business valuation. Valuation, in simple terms, is the financial worth of a company. Now let's talk about what that actually means. At its core, valuation is a process that involves a series of procedures used to estimate the economic value of an owner's interest in a business. Think of it like this. If you were to sell your company today, what price should you ask for? That's essentially what valuation is all about. Valuation is used by financial market participants to determine the price they are willing to pay or receive to effect the sale of a business. It also comes into play during mergers and acquisitions, when both parties need to agree on a fair value for the company being bought or sold. There are several fundamental aspects to consider when valuing a company. First, we have the company's assets. These could be physical assets like buildings and machinery, or intangible ones like patents and trademarks. Next, we have to consider the company's earnings. This is the profit that the company makes after all expenses are deducted. It's important to note that a company's earnings can fluctuate from year to year, so it's often more accurate to look at the average earnings over a certain period. Another crucial aspect is the market value of the company's shares. This is the price that people are willing to pay for a share in the company on the stock market. It's a good indicator of what the market thinks the company is worth. Finally, we need to consider the company's future prospects. This involves estimating future earnings and growth rates. It's a bit like gazing into a crystal ball, but with a lot more math involved. So, to sum up, valuation is a complex process that involves looking at a company's assets, earnings, share price, and future prospects. It's a vital tool for anyone looking to buy, sell, or invest in a company. Getting a grip on these basic concepts will make the rest of the journey smoother. There's more than one way to value a company. Indeed, when it comes to determining the worth of a business, several methods come into play. Each method provides a unique perspective, aiding in a comprehensive understanding of a company's value. Let's dive into three of the most commonly used valuation methods: the discounted cash flow method, the market capitalization method, and the earnings multiplier. Starting with the discounted cash flow, or DCF method, it's all about future projections. This method operates on the principle that a company's value is equal to the present value of its future cash flows. In simpler terms, think of it as a sophisticated crystal ball that predicts how much money a company is going to make and then discounts it back to today's dollars. It's a favorite among investors who like to plan for the long term. Next up is the market capitalization method. This one's quite straightforward. You take the current market price of a company's share and multiply it by the total number of shares outstanding. The result is the company's market capitalization, which represents the total value of a company according to the stock market. It's like the price tag put on a company by the collective wisdom of all market participants. Last but not least, we have the earnings multiplier. This method values a company based on its earnings potential. An earnings multiplier is used to convert these earnings into an estimate of the company's value. If you're looking for a quick and dirty estimate, this might be the method for you. Now, it's important to note that none of these methods are perfect. The DCF method is highly dependent on accurate future cash flow predictions, which can be tricky. The market capitalization method is susceptible to market volatility, and the earnings multiplier doesn't account for future growth potential. Each method has its strengths and weaknesses, and the choice often depends on the specific situation. So, whether you're an investor, a finance student, or just someone interested in the business world, understanding these valuation methods can give you a significant edge in your financial journey. Now, how does valuation work in the real world? Valuation is not just a theoretical concept. It has significant practical applications across various aspects of finance and business. Let's start with mergers and acquisitions. often referred to as M&A. When a company is considering acquiring another, it needs to know the worth of the potential acquisition. Valuation helps determine this worth, providing a basis for negotiation between the buyer and the seller. Investing is another area where valuation plays a pivotal role. Whether you're a seasoned investor or a novice dipping your toes in the investment pool, understanding the intrinsic value of a company is key to making informed investment decisions. Valuation helps investors determine whether a company's stock is overpriced or underpriced, guiding their buy or sell decisions. Now let's talk about financial reporting. Companies often need to report the value of their assets and liabilities to regulatory bodies and shareholders. Valuation methods are used to ascertain these figures, providing a clear picture of a company's financial health. But valuation doesn't just help us put a price tag on companies or assets. It plays a vital role in decision-making. For instance, a company planning to launch a new product or enter a new market would use valuation to assess the potential profitability of these ventures. If the valuation indicates a high potential value, the venture is likely to be pursued. Conversely, if the valuation is low, the venture may be reconsidered or even scrapped. So you see, valuation isn't just about crunching numbers. It's about understanding the value behind those numbers. It's about making sense of the financial landscape, whether you're looking to acquire a company, invest in a stock, report your financial status, or make strategic business decisions. Understanding valuation can be a powerful tool for investors and business leaders alike. So let's continue to unravel the complexities of valuation in our next segment. Valuation isn't always as straightforward as it seems, and that's because there are a few misconceptions that often muddy the waters. So let's clear them up, shall we? Firstly, many people mistakenly equate price with value. However, these two are not the same. Price is what you pay, and value is what you get. Price is influenced by market conditions, investor sentiment, and a host of other variables. On the other hand, value is intrinsic. It's based on the underlying fundamentals of the business, such as earnings, assets, and growth prospects. So when you're valuing a company, don't just look at the price tag. Dig deeper. Examine the business's fundamentals to determine its true value. Secondly, there's a common misconception that market conditions don't affect valuation. This couldn't be further from the truth. Market conditions, like interest rates and economic growth, can significantly impact a company's value. For instance, in a low interest rate environment, businesses can borrow cheaply, which can boost their growth and, by extension, their valuation. So don't ignore the market. It can provide a crucial context for your valuation. Lastly, many believe that valuation models are infallible. In reality, these models are only as good as the data fed into them. Plus, they often rely on assumptions about future performance, which can be wildly inaccurate. And let's not forget, models can't account for unforeseen events like economic crises or industry disruptions. So, while valuation models are useful tools, they're not crystal balls. They should be used as a guide, not a gospel. In conclusion, understanding valuation requires us to move beyond these misconceptions. It requires us to recognize that price is not value, that market conditions do matter, and that valuation models have their limitations. And above all, it requires us to appreciate the complexity and nuance of this process. Remember, valuation is as much an art as it is a science. So, we've taken a deep dive into the world of valuation. We've learned that valuation is more than just throwing numbers on a balance sheet. It's an art, a science, and a vital tool for making informed financial decisions. We've explored the basics, from the fundamental concepts to different methods employed in the industry. We've seen how valuation can be applied in real-world scenarios, and we've debunked some common misconceptions that often cloud our understanding. Remember, valuation is a dynamic process. It's not a one-size-fits-all solution. It requires a keen understanding of the business, the market, and the broader economic landscape. It's about unearthing the intrinsic value of a company and making sense of complex financial data. So don't shy away from the numbers. Embrace them. Let them guide your financial journey. The next time you ask, "What's this company worth?" you'll have a better understanding of what that really means.